I remember one of our first interviews in 2019, you talked about corporations going on a debt diet. What did you mean, and how do you think it turned out?
I think it turned out extremely well. What I meant was that a lot of these weaker BBB companies would focus on reducing their leverage, cleaning up their balance sheet a little bit, and we saw company after company do that, whether it was Budweiser, AT&T, Verizon, Newell Rubbermaid, Kroger, and the list goes on, and you're in much improved credit situation for all these companies, which has actually benefited the stock market as well.
All right, now we've looked at the side of the issuers. Now let's look at the side of the investors that like to buy the securities that they are issuing to clean up and deleverage and do it at lower rates. We've seen big supply, record year. We're probably showing the Barclays credit spreads right now, whether it's investment grade or high yield. Boy, they just keep narrowing and narrowing. On the investment grade, it's now under 100. Although, on high yield, even though the spreads have collapsed, which is a good thing, on the 20th of this month, Moody's said they're nervous. They warned of a frothy U.S. junk market. Weigh in.
Yes, I think first it's been a great year, and the more risk you took, the more you're rewarded. I think you want to be a little bit cautious here, particularly on the high yield side. One thing that I've seen over the past month is really what I see as short squeeze. So some of the weaker CCC credits, which is the really bottom end of the credit spectrum, I think they rallied a lot based on short squeeze positioning. So I think you could see a little bit of a pullback. So I think you want to be careful in high yield, a little bit careful in leverage loans, though right now I almost prefer the leverage loan market to the high yield market. But I would be taking profits there. I'd be reducing exposure to high yield right now.
Now, how much do central banks generically have to do with this global appetite, this insatiable appetite for investors? It's like they have a sweet tooth, and anything corporate is a big piece of chocolate. Does anything worry you here that we could have any quick changes in sentiment on the investor side?
Yeah, I really think both the Fed and the ECB have been incredibly supportive of the bond markets. If you look, credit spreads tightened in Europe, partly because we reinitiated QE. The ECB is buying corporate bonds. You're seeing American companies issue into that. In the U.S., you really saw three turning points in markets here. There were three periods where we were a little bit weak, and we bounced. First in December and January of last year, where the Fed really said, hey, no more cuts, no more hikes. Then they started doing the insurance cuts back in May and June, and then they started regrowing their balance sheet in September and October. I think the Fed is not going to be able to be supportive of the markets. I don't think we get any more cuts. I think they start talking about the maximum size of the balance sheet. So I think there's going to be some headwinds. So again, you want to be a little bit cautious and take some profits here. It's been a great year. It's going to be a little bit tougher this year going forward.